As of 12:45 p.m. Eastern Time on this Friday, October 31st, 2025, Opendoor Technologies, ticker OPEN, is trading at $7.73. That is a significant intraday move, up 39 cents or 5.31%. This isn't a quiet drift upwards. This is happening on absolutely massive trading volume, with nearly 58 million shares already changing hands today, far exceeding its average. The stock has been scraping its way up from a 52-week low of nearly 50 cents to a high of $10.87, and today's action shows it remains one of the most contentious names on the entire market. But this rally, this surge of green on the screen, isn't a simple story of investor confidence. It's a battlefield. What's truly fascinating is that this stock is one of the most heavily shorted names available to trade. As of the last official report from October 15th, a staggering 161 million shares are held short. That is a massive, coordinated institutional bet that this company's stock price is going to fall, and fall hard. Today's 5% jump is less a sign of clear skies and more the feeling of a coiled spring getting tighter. The common belief, the narrative that has propelled this stock on a more than 700% run since its lows in June, is that Opendoor is the future. The expectation is that this is the technology-first iBuyer that will finally drag the archaic, agent-filled real estate process into the digital age. Investors who are long this name are betting that with the Federal Reserve signaling potential interest rate cuts on the horizon, the housing market will stabilize, demand will return, and Opendoor's high-tech, high-leverage model will finally, definitively work. The reality, however, is what those 161 million shorted shares are betting against. The reality is what Wall Street analysts are saying in their reports. The consensus analyst price target for this $7.73 stock isn't $10 or $12 or even its current price. The average target is $1.78. That represents a 76% decline from where it is trading right now. Institutions, on average, are not looking at Opendoor as a disruptive tech company. They are looking at it as a capital-intensive, highly leveraged home flipper that is fundamentally chained to the 30-year mortgage rate. The reality is that institutional ownership in aggregate has been decreasing over the last quarter. Major holders like Vanguard and T. Rowe Price have been reducing their positions. And the reality is that analysts have been slashing their earnings estimates for the upcoming report, with revenue expected to be down over 38% year over year. Let's look closer at this recent action and the short position, because this is where the real story is. Today's 5% jump on 58 million shares of volume is not normal quiet accumulation. This is high-velocity, speculative trading. It's a potent mix of retail enthusiasm, driven by forums on Reddit and discussions on X, colliding with short sellers who are either taking profits, managing their risk, or perhaps even getting squeezed out of their positions by the stock's relentless upward momentum. The short position itself is not new, but it is growing. That 161 million share figure is up from 150 million just a few weeks prior. This is a compounding bet by major funds that Opendoor's business model is not just challenged, but fundamentally flawed in a volatile market. The short thesis is brutally simple. They believe Opendoor used its capital to buy thousands of homes at or near the peak of the housing bubble and is now being forced to sell that inventory at a loss as high mortgage rates choke off buyer demand. Even more telling, we see signs of extreme market stress in the company's fail-to-deliver data. The value of FTDs in 2025 has exploded by over 2,300% compared to 2024. For many retail investors who track this data, this is a massive red flag. A fail to deliver occurs when a party in a trade fails to deliver the shares on the settlement date. While there are administrative reasons for this, a chronic, massive spike like this can suggest naked short selling or extreme difficulty in locating legitimate shares to borrow. Now, you'll see a days-to-cover ratio of around 1, but that figure is deceptive. It's only low because the average trading volume has been astronomically high. It simply reflects the intensity of the battle. If you want to track this yourself, you can look up the official short interest data published by NASDAQ twice a month. More advanced traders will watch the cost-to-borrow fee, which is the interest rate shorts must pay to borrow the stock. When that fee spikes, it means shares are scarce and shorts are paying a high premium to maintain their negative bet. That can be a powerful precursor to a short squeeze as it becomes too expensive to stay short. What's your take on this massive short position? Is it a sign of smart money seeing the iceberg before everyone else? Or is it a coordinated attack on a company just as it's trying to find its footing in a new market environment? This entire conflict is playing out ahead of the company's next earnings report, which is scheduled for November 6th. The company is even hosting what it calls a financial open house on Robinhood, a very clear and direct nod to the retail investment community that has become its primary support base. The expectations for this report are already incredibly low, a consensus loss of $0.07 per share and that painful 38% drop in year-over-year revenue. But frankly, those headline numbers do not matter. Here is what you must watch in that report. Forget the EPS. Forget the revenue beat or miss. The only metric that matters for Opendoor is its contribution margin per home. This number tells you if the company is actually making or losing money on its core business of buying and selling a house. Is that number positive? If so, by how much? And second, what is the total value of their home inventory and how much have they had to write it down? If they report another massive inventory write-down, it confirms the entire short thesis. If they can show a positive and growing contribution margin, even in this high-rate environment, it would prove their pricing algorithms are working and the short sellers could be in a world of trouble. To understand why this one metric is so critical, you have to remember what Opendoor does. They are the leading iBuyer. You go to their website, type in your address, and they give you a fast all-cash offer. They aim to do minor repairs and then resell that home on the open market for a small profit, collecting a service fee in the process. It's a high-volume, low-margin business that requires an enormous amount of capital. You need billions of dollars on your balance sheet to hold thousands of homes at once. This model looked like genius when the Federal Reserve held interest rates at 0 and home prices only ever went up. The stock soared after its SPAC merger, but the model shattered in 2022. When rates spiked, the housing market froze, and Opendoor was caught holding the bag. They lost $1.4 billion that year. They were forced to liquidate inventory at steep losses. This is the core risk. Opendoor is not a software company. It is a real estate trading desk, and its primary and most powerful counterparty is the Federal Reserve. Its stock price, with an extreme beta of 2.8, doesn't trade on its own fundamentals. It trades as a direct, leveraged proxy for interest rate expectations. This is why Zillow and Redfin, Opendoor's main competitors, both quit the iBuying business. They publicly stated that forecasting short-term home prices was too unpredictable and the business was too volatile. Opendoor was the only one that stayed, betting its data and algorithms were superior. Comment below with your prediction for the November 6th earnings. Will they finally show a positive contribution margin, or will it be another painful inventory write-down? This brings us to the two opposing futures for this stock. The bull scenario is clear and compelling. If the Fed does pivot and mortgage rates begin to fall through 2026, the housing market will find a floor. Opendoor, having survived the downturn, could scale rapidly with its key partnership with Zillow, which feeds at potential sellers. This would ignite its revenue, prove the model, and force those 161 million short shares to be bought back, creating a historic mother of all short squeezes. The bear scenario, the one the shorts are betting on, is just as clear. Rates stay high, the housing market stagnates for years, and the company's cash burn continues. They will be stuck with depreciating assets, unable to generate a profit, and will be forced to relentlessly dilute shareholders by selling more stock just to keep the lights on. The fact that the professional analyst community has an average target of $1.78 tells you exactly which scenario they believe is more likely. Ultimately, when we look at Opendoor trading at $7.73, we are watching the perfect storm of expectation versus reality. The expectation, held by a passionate retail base, is a disruptive technology company on the verge of a massive turnaround fueled by a meme stock-like rally. The reality, held by institutions, is a deeply distressed, capital-intensive